Morning guys, Joel Frank here, market analyst for YouTrading, and in today's video I'm going to give you a brief market update. What are the main developments of the week across different asset classes? What are the main themes driving markets at the moment? So let's jump right into it. We'll start off by looking at euro dollar, because in currency markets the euro has certainly been the most interesting currency this week. And you can see here these are 1 day candlesticks, so we are taking a long-term view here. Euro dollar has been finding resistance at these highs in the upper 102s in recent days, and that 21-day moving average has also been providing resistance. And you can see here that we dropped about 1% on Tuesday, quite a large intraday drop, and that was pretty much because since the start of the week, developments in the Eurozone have been bearish. Okay, so on Monday you had Gazprom, Russia's state-owned gas exporter, announcing that they were going to be reducing flows through the Nord Stream 1 pipeline by or to just 20% of their usual capacity. This obviously comes after all that maintenance period that ended last week, and in response to that, I mean, the Western nations pretty much see that Russia says that they're reducing these flows because of like maintenance issues, and they need to wait for some turbine and all this kind of stuff. But Western nations see this as a retaliation for their support for Ukraine. Obviously, Russia is currently invading Ukraine. So, in response, Western leaders had an emergency summit on Tuesday, and energy ministers agreed to reduce their gas usage. Pretty much some limited rationing between now and next March. But things could get much worse, because we're still getting 20% from Russia. What if that goes to zero? Like, there is a lot of uncertainty at the moment. And the reason this weighs so heavily on the euro is because the Eurozone industrial sector, particularly in countries like Germany, is very energy intensive. And historically they've done very well because Russian energy is very cheap, and it's been able to power their exports basically, but it looks as though if there is gas rationing, industrial activity is going to be hit, because obviously you have to prioritize heating homes as opposed to, you know, powering manufacturing production. Obviously that's a terrible thing for the economy, so that's why we've seen this weakness in the euro, to reflect this sort of higher likelihood that we see gas rationing impacting economic activity within the next, you know, couple of quarters. And by the way, it's not that we're waiting for gas rationing to have an impact, it's already having an impact. Gas prices and energy prices generally in the Eurozone are through the roof, and that's already, according to a survey that was released in Germany over the weekend, that's already resulting in reduced industrial activity in Germany. So it's already having an effect, all the uncertainty. But yeah, we did see this big drop in Eurozone bond yields on Tuesday. Some paring back of ECB tightening bets. That's even despite the fact that on Monday, ECB policymakers like Christine Lagarde and a couple of others, they actually were sounding kind of hawkish, like they were hinting that another 50 basis point rate hike is possible in September. But markets don't seem to be buying into the ECB tightening story anymore. They're thinking about, listen, if the Eurozone economy is going to be this weak because of gas rationing and all that kind of stuff, then the ECB is not going to be able to tighten that much. That seems to be the prevailing narrative at the moment, and then that is why the euro fell. Looking at it all from a technical perspective though, this week's price action isn't particularly meaningful in the big picture. We still got this trend line, this bearish trend line that we've been in since, well, pretty much the whole year, to be honest, and we're still very much locked within this bearish trend line, and traders seem to be, for now, looking to sell rallies. So anything, I've been talking about this feels like for weeks now, but this area of resistance here around 103.50 or potentially 104, or potentially the 50-day moving average, which is just here, any sort of rally up here, you know, if the Eurozone economic picture remains as ugly as it currently is, that's going to be sold. Now what could take us there? Well, I spoke about this in one of my trade ideas earlier in the week, I think, but we do have the Fed meeting coming up, okay, and that could result in some significant short-term volatility for FX markets. Obviously, if euro dollar is going to rally, that's going to require that the Fed be dovish. Are the Fed going to be dovish? I think there is a chance that they might come across as a little bit dovish. So, okay, market's already expecting this 75 basis point rate hike. That's as good as done. There's still an outside chance that they might do a 100 basis point rate hike, but a couple of reasons I think they won't. Number one, there are signs that inflation has peaked or is in the process of peaking, whether that's core price pressures, whether that's the recent drop in commodity prices, like we're about to go through oil, and you'll see that that's been on the back foot for the last couple of weeks. And also, various different measures of inflation expectations have also been moving lower recently. So the Fed's, though headline price pressures, according to the CPI data in the US that was released earlier this month, are still very high, other indications aren't so bad, so the Fed's probably not going to be as worried as they were at their last meeting, or at least not any more worried. That seems to be likely. And then also, obviously, we've had a lot of indications that the US economy is also weakening. Not as bad as the Eurozone, but the PMIs last Friday were ugly. Recent housing data has not been good. We had consumer confidence data for a long time has been bad, and we just had some more yesterday on Tuesday that was showed a third successive decline. So, yeah, maybe we do get a more dovish sounding Fed. It's all about, how does Fed Chair Jerome Powell sound in his post-meeting press conference? And if that is the case, then we could see markets paring back on Fed tightening bets, which could give, euro dollar and other pairs like cable a lift in the short term. Speaking of cable, by the way, let's take a look at cable. Also trending lower, though it has managed to get above its 21-day moving average, and does look like it's going to probe this downtrend soon. And obviously, I've been talking about maybe a dovish Fed, and if we do break out of this, then we could be looking at a test of the 50-day moving average here, just above 122. But again, even though that would be a technically significant break of this long-term trend line, I just, with the UK economy also performing poorly relative to the US, with the tightening outlook from the Bank of England also less aggressive than the Fed's, I just don't see how we could get past, say, this resistance in like the 124 area, or at very, very best, this resistance up here in 126. I do think we're still heading lower from that. Yeah. Moving on. Stocks. We've had quite a lot of earnings this week. And, well, the first thing to say was we had this surprise profit warning. Wasn't their earnings release, but a profit warning from Walmart, which shook sentiment a little bit yesterday. So we had a nice red candle, but we did bounce at the 50-day moving average. This is the S&P 500, by the way, on one-day candlesticks. Always looking at one-day candlesticks. But since then, since the Walmart profit warning, we've had good news from Microsoft and Alphabet, which is Google's parent company, both posting pre-market gains after that. So that's lifted sentiment this morning. So really, stocks are just ranging within recent ranges, finding support for now, which is a good sign, technically speaking, and waiting for the Fed. And again, if the Fed is dovish, which I'm thinking there's potentially a bit of a chance for, we could be looking at a rally back towards last week's highs. And if earnings for the rest of the week, we still got quite a lot. We've got like Apple, Amazon, I think we got Meta Platforms, Facebook's parent company, and there'll be plenty of other earnings as well. If they continue to generally be good, which for the most part they have been. Remember yesterday we also had Coca-Cola and McDonald's, another two massive companies. Both of them posted good earnings too. So, yeah, like I'm saying, if the earnings story remains positive and the Fed is a little bit more dovish, then who knows, next couple of weeks we could be pushing higher. Although in August, typically that's not a good month for equities, historically. So just bear that in mind before you get overly aggressive in the next couple of weeks, if we do start going higher. Final thing to look at, let's just quickly look at oil. I've been interested in watching oil decline in the last couple of weeks. We've been in this trend line. This is all part of the inflation likely having peaked story, by the way. So the more oil falls, probably the better it is for risk appetite at the moment. But for now, you can see we're holding above this 200-day moving average, which is this green line here, but still within this downtrend. Obviously, I've been given all these reasons about how the Eurozone economy, the US economy, other economies are weakening. China's doing a little bit better at the moment, but they've been having these stop-start lockdowns, so, you know, another spread of coronavirus cases in China could further add to this downside case for oil. And as I've been pointing out in other videos, I think that a break below this 200-day moving average and support in this kind of area here, around 93, could open the door for a relatively swift drop down to around $84, $85 per barrel. And again, I think that could help sentiment. In terms of the rest of the week, let's look at the calendar quickly. Obviously, we've got the Fed today, but then also got a couple of other things to be keeping an eye on, like US GDP on Thursday. Could show, because remember we had negative GDP growth in the first quarter. If you get 2 consecutive quarters of negative GDP growth, then that is a technical recession. US officials will be reluctant to call it a recession because, you know, a real recession is also when you have things like the unemployment rate rising, which hasn't been the case in this year. So it's more of, it's not like a deep recession where people are losing their jobs. There is the potential we could turn into something like that, though, by the end of the year. So keep an eye on that. That's certainly going to be a big talking point. Whether or not it moves markets remains to be seen. Eurozone CPI flash for July. The ECB is obviously talking about how it's data dependent now. It might do another 50 basis point hike, might do 25. Going to have to watch the data. Well, this is the data. This is the data you need to be watching, Eurozone inflation. We're looking at another rise in the headline rate to 8.7%. Canadian GDP, worth watching for the loony traders. And then US core PCE, which is the Fed's favoured gauge of inflation. That's for June. That'll also be worth watching. But yeah, guys, that's pretty much what to look out for the rest of the week. Hope you found the video helpful. Hope you enjoyed it, and I will see you all in the next one.